Hello everyone. Today we will be presenting our analysis of a significant strategy shift in the global energy sector. Our case study focuses on BP's 2025 decision to pivot away from its green energy commitment. We are Group 24 and our team members include Milan, Priya, Emma, Wenwei, Abby, and Yihan.
Hi there. I'll be introducing our case on BP. I'll cover the background, the purpose of this presentation, and the frameworks we'll use to analyze BP's strategy. BP, or British Petroleum, is one of the world's largest multinational energy companies, operating in over 70 countries. Traditionally, it has focused on oil and gas, but in recent years, it has also aimed to grow in renewable energy and move towards net zero emissions by 2050. In February 2025, BP announced a major strategy shift. The company decided to increase annual investment in oil and gas to 10 billion US dollars, while cutting over 5 billion from renewable energy. At the same time, BP lowered its targets for reducing emissions from its products, focusing on reducing carbon intensity rather than absolute reductions. The purpose of our presentation is to explain why BP made these changes, assess the advantages and the disadvantage of this strategy, and show how it relates to the UN Sustainable Development Goals. Finally, our group will provide recommendations for how BP can balance these pressures while remaining competitive and responsible. To guide our analysis, we'll use three frameworks. First, institutional theory. This explains how companies respond to pressures from investors, governments, and society. Second, the dynamic capabilities framework, which focuses on how companies adapt and reconfigure resources to stay competitive. Third, a sustainability and SDG lens, which lets us evaluate BP's strategy in terms of both business performance and environmental and social impact. Using these three lenses, our group will analyze BP's strategy from multiple angles, helping us understand the reason behind the change, the risks, the opportunities, and the potential impact on the company's future.
BP has recently received its energy strategy. It's cut about 5 billion from renewable and redirected an additional 10 billion each year into oil and gas. The CEO explained this shift by saying the transition went too far too fast. The immediate goal is to restore cash flow and increasing shareholder returns. From a dynamic capability perspective, this creates short-term financial security, but risk eroding BP's renewable expertise. Looking at scale, scope, speed, BP is expanding oil and gas at scale while slowing and narrowing its renewable project. Finally, from the entry model, BP is moving away from own and operating assets toward islands and joint ventures. They are capital light and share risk, but also limit control. So, the strategy question becomes, can BP balance immediate return with its long-term adaptive capacity?
From a corporate social responsibility perspective, BP's strategic shift can be understood in relation to the external environment. One of the key external factors is the focus on climate regulations and the broader climate change agenda. Governments worldwide are implementing stricter carbon pricing, emissions targets, and renewable energy. This regulatory pressure directly impacts BP's operational costs and future investment decisions. At the same time, there is also significant ESG pressure. Institutional investors that are driven by sustainability concerns and long-term value are increasingly scrutinizing companies' environmental footprint and social impact. BP's decision to increase oil and gas investment by 10 billion while cutting over 5 billion from renewables in 2025 creates a complex CSR landscape. It risks alienating the investor segment as well as damaging its reputation. This could potentially lead to a lack of legitimacy within the institutional theory framework. The oil and gas expansion has helped to protect jobs in traditional energy sectors, but the reduced investment in wind and solar projects slows their progress towards clean and accessible energy and also grows their long-term carbon footprint. Energy security concerns, wars, and sanctions also influence BP's operating environment and puts them under external pressure. Events like the Russia and Ukraine war have put stress on rapid, unpredictable change in global energy markets and the strategic importance of diverse energy sources. This context can provide a short-term rationale for BP's renewed focus on traditional fossil fuels to secure energy supply and generate stakeholder returns. However, this approach risks neglecting the crucial, sustainable, and resilient energy systems in the long term. Balancing these immediate energy security demands with long-term climate action and societal expectations is a core CSR challenge for BP.
To look at BP's internal environment, we have used the Global Integration Local Responsiveness Framework so we can look at how BP balances efficiency and adaptation in the market. If we first look back to 2020, BP exhibited a transnational strategy by prioritising efficiency and local responsiveness. They set net zero targets, were regularly investing in renewables and new innovations as well, and these aligned with EU and UK climate policies. They were responsive to external pressures from institutions while still maintaining its global oil and gas scale. By 2025, however, BP has now shifted towards a global strategy. They have raised both oil and gas spending and are now pursuing a centralised and standardised fossil fuel model across their operations. This supports economies of scale, operational efficiency, and consistent investor messaging. It also leverages BP's already integrated supply and trading operations, strengthening resilience in volatile energy markets. However, this shift reduces local responsiveness. In markets such as Europe and the UK, where climate policy is tightening and there is an increased demand for renewables, BP risks misalignment. By cutting renewable investment and dropping its absolute Scope 3 target, BP exposes itself to reputational vulnerability and stakeholder backlash, particularly from NGOs and ESG-focused investors. Now we'll move on to both the pros and cons of this shift for BP, done through a dynamic capabilities and institutional theory lens. On the plus side, BP's change shows how the company is responding to current external pressures like the Ukraine war. By reallocating $10 billion into oil and gas, they expand their production capacity at a time where there is strong demand and volatile prices. This allows BP to capture cash returns in the short term, which will help them secure supply contracts and benefit from price spikes. Doing this, BP is actively configuring its resources to maximize profitability in the current energy market. From an institutional theory perspective, the strategy also reflects alignment with powerful external factors. Investor Elliott Management, which recently acquired a 5% stake in the company, pressured for stronger shareholder returns, and this would have come from other investors as well. Therefore, meeting these demands helps restore market confidence. Along with this, governments that currently face energy insecurity with the still ongoing Ukraine conflict have prioritised stable hydrocarbon supply to protect affordability and avoid shortages. By responding to these institutional pressures, BP reinforces its short-term confidence from both investors and policymakers.
This strategy have clear downside. First, from a dynamic capability perspective, cut $5 billion from renewable vacant BP's adaptability and risk long-term lock-in. Second, using institutional theory, scaling back oil reduction target from 40% to 25% undermines BP's legitimacy under EU and UN's climate norms. Investor and regulator may be view it as inconsistent with Paris goal. Third, through an interim lens, shifting to islands and GVs save capital but reduce control, raising risk of opportunism and weak integration. Overall, while those moves may improve short-term returns, they create significant change for BP's long-term credibility and adaptability, issue we will address in our recommendations.
Hello everyone, I'm Wenwan Yiwu. Now, let's look at BP's new strategy through the UN Sustainable Development Goals. The impacts are mixed, which means there are good and bad sides. So first, for SDGs, decent work and economic growth, focusing on oil and gas may protect or create jobs to support local economics, but the downsides are clear. For SDG 7, affordable and clean energy, cutting back on wind, solar slows progress in making renewable more accessible. Most importantly, for SDG 13, climate action, investing an extra 10 billion in oil and gas means higher emission, which undermine global climate targets. So, let's sum up. BP's plan may help jobs now, but risk our clean energy future and climate goals.
To move forward, we recommend that BP adopts a hybrid strategy that secures short term gains from oil and gas while reinvesting a defined share of those profits into clean energy transition. This balanced approach addresses the immediate pressure from investors and governments, but also keeps BP future ready as energy markets evolve. First, BP should strengthen its ability by channeling a portion of current hydrocarbon profits into technologies such as carbon capture and green hydrogen. These areas are increasingly backed by European policymakers and global investors as credible pathways to net zero. By ring fencing investment in this way, BP protects itself against the risk of being locked into a fossil heavy portfolio and avoids losing the technical expertise it has been building in renewables. This recommendation directly applies the Dynamic Capabilities Framework, which emphasizes that firms must continuously reconfigure and upgrade their resources base to survive disruption. Second, BP must rebuild its legitimacy with key stakeholders. Earlier analysis showed that cutting renewable commitments weakened BP's social license to operate, a central concern under institution theory. While some investors have pressed for stronger short term returns, regulators and ESG focused funds are demanding credible evidence of decarbonization. A practical step is for BP to commit to transparent climate reporting frameworks that clearly demonstrate how profits are being reinvested in transition projects. This would reduce reputational risk and restore institutional alignment, ensuring BP is seen as meeting both shareholder and societal expectations. Third, BP should broaden its responsiveness in heavily regulated markets by forming targeted alliances with local renewable energy firms. The Global Integration Local Responsiveness Framework showed that BP's shift towards a centralized global strategy has reduced its local sensitivity, particularly in Europe and the UK. Strategic alliances would allow BP to access local knowledge, share costs, and re enter the renewable space without bearing the full capital burden. Alliances of this kind also reduces imitability and helps the company resonate better with local communities. Finally, BP should formalize a profit for purpose capital allocation model. In practice, this means setting aside a fixed percentage, for example 30%, of hydrogen carbon earnings directly for transition projects. This ensures that short term profits are not seen as an end in themselves, but a bridge to long term sustainability.
Lastly, you can see here's our reference list. So, let's in short, BP's strategy shift is a direct response to investor pressure for quick profits. They're focusing back on oil and gas, what they do best before, and our analysis shows it's a practical short-term move, but it is high risk. The big trade-off it helps finance and jobs now, but it hurts long-term sustainability and climate goals. So we recommend a balanced approach. Use profits from oil and gas to invest in cleaner technology like carbon capture. In this way, BP can succeed today without losing sight of sustainability. Okay, so that's all we are talking about in this presentation. Thank you for your listening.